Hello, this is Steve St. Angelo once again from the SRS Rock Report, and I'm glad you're joining me today. Now, it's been a while since I've done an update, but this is an important one because I believe a lot of precious metal investors, including regular investors, do not understand the tremendous hidden value in every silver coin. And I'm going to explain in detail why in this update. Now, it is also true for gold, but due to the fact that there's not that much more above ground silver investment stocks as there's gold, I do believe when investors start to move into the precious metals to protect wealth, and they will, silver is going to be the go-to asset because the value of the price is so much lower. It's just a better deal. Okay, let's get started. Now, this first chart, it just shows us the investment demand as a percentage of total global demand of the various precious metals, where most of precious metal demand comes from. Now, we've got the top four precious metals: gold, silver, platinum, and palladium. Now, this is very interesting. Now, palladium right now is stealing the show. It's getting the most attention. The price is shot up to $2,500 an ounce. And what's interesting, there's not much physical palladium investment. It's only 0.3% of the total market that year. Now, why is the price moving up so much? And I believe this is due to industrial consumption, industrial demand, and I'll get into that in a minute. But if we look at these four, gold is clearly the winner in percentage terms. Data is based on 2018 for gold. All global gold demand, 37% was in physical investment. That's private, including central bank purchases. Now, silver, it was 18% physical investment demand. Platinum was only 4% of the market, and palladium 0.3%. Now, the next chart does the same thing, but breaks it down into troy ounces. And as we can see, if we're looking at troy ounces, silver is the clear winner. According to the Silver Institute's interim report, they haven't come out with their 2020 survey yet, but they forecast there was 178 million ounces of physical silver investment in 2019. Now, for 2018, gold was 47 million ounces of physical gold investment, and then platinum, palladium are well behind. Platinum, 287,000 ounces of platinum investment and only 29,000 of palladium. Now, this next chart, I want to show you a few charts on palladium. We could see this is a monthly chart of palladium, and it's moving up exponentially. It's starting to get into a blow-off phase. But I do believe the reason why we're seeing the price move up it's a structural fundamental problem deficit with industrial consumption. Now, this next slide, this is an article by Craig Hemke at TF Metals Report. He does a pretty good job over there. It was on Zero Hedge this morning. It says the magic palladium bullet in 2020. And what Craig is saying is the situation in palladium is unique, and it holds the possibility of exposing and even threatening the entire LBMA COMEX fractional reserve and digital derivative pricing scheme. And Craig is partially correct here because it seems like there's banks that are supposed to supply palladium, but they don't have enough metal, so they're leasing palladium, and it's pushing up the rates. So it is making the situation worse. But if we look at the next slide, this is platinum versus palladium annual surpluses and deficits. This is over the last 10 years. Now, platinum is in white, and these numbers are in 1,000 ounces. So we could see platinum had some surpluses, some deficits, but overall, it seems to be somewhat balanced. Now, this isn't the case for palladium. Palladium, for example, in 2012, it had a 1 million ounce deficit, and the deficits have continued to increase. And in 2019, it was forecasted it would be 1.8 million ounce deficit. Now, the 2019 World Platinum Metals Group survey said at the end of 2018, total global palladium above ground stocks was about 6.3 million ounces. So if we remove the 1.8 million, it's now down to about 4.5 million ounces of above ground palladium stocks. So it's clearly a structural deficit because palladium is used in gasoline catalytic converters. And now in China, they're more stricter on their emissions, and we're seeing the same thing in India. Also, because of the Volkswagen diesel scandal, more European companies are moving to gasoline catalytic converted engines. So they're using a lot more palladium. Platinum, again, is used in diesel catalytic converters. So if we look here, the platinum auto catalyst is 41% of platinum's market, but palladium auto catalyst is 81% of its market. So we can clearly see this is a structural deficit. And I do believe what we're seeing in palladium on this short-term basis on industrial demand is the same thing that's going to happen to gold and silver on an investment demand in time, and especially with silver. All right, before I get into the hidden value of silver, I want to show you a few charts. Now, I said back in the summer, silver was coiling in this symmetrical triangle right here. And it finally broke out above it when gold broke out in July and August. Silver shot up to this first resistance level of 1850, and it's been trading off of the 50-month moving average and below it. We can see the close-up here. Now, this next chart of silver shows a little bit longer chart, going back to when silver was $50 an ounce here. As it consolidated, it stayed above this strong support level. Then when it broke, it stayed below it. So now this line became a resistance level. And then it finally, in 2019, not only broke above the 50-month moving average in blue, it's now staying above this resistance level, which is now a support level. Now, it could go back down to 1650 for a correction, but due to the fact that there's so much issues now with the market, with the Federal Reserve and the repo market, and the $60 billion a month of U.S. Treasuries, and they're doing all this and there's no recession. I believe the precious metal prices will remain strong. Even though we may see a correction, I do think we're going to see higher precious metal prices in 2020. Now, this last chart is on gold. And again, gold broke out of this 1360 level in the beginning in July, and then it shot up to the first resistance level, which was 1550, 1560, touched it twice, consolidated, and then we had the Iranian situation. It went all the way up above 1600. But there's no coincidence that gold, the traders are keeping it below this resistance. Once it breaks above and closes above this on a monthly basis, I do believe the price of gold will continue higher. Now, the total world identified of physical gold and silver investment in 2018 hasn't changed much in 19. It was about 2.4 billion ounces of gold and about 2.4, 2.5 billion ounces of silver. Now, because silver is only worth $18 an ounce, it's about $45 billion for all this silver compared to 3.7 trillion for gold. Now, if we look at this 45 billion, and I am comparing it to the total M2 money supply. Most of it is for the US, but the 45 billion for global silver stocks, I'm comparing it to this M2 instead of gold because I believe silver is going to be the go-to asset. This M2 money supply includes M1, and I'll show you in a minute, but there's 15,432 billion of this M2 money supply, or 15.4 trillion. That doesn't include stocks, bonds, or real estate. This is just the money supply compared to 45 billion of all global silver stock value. Now, it's interesting. This is according to the Federal Reserve, St. Louis Fed. Before the 2008 financial crisis, there was 7.5 trillion of the M2 money supply, and now it's more than doubled. It's now 15.4 trillion. So it's doubled in just the last 11 years. Now, this is the same chart. It's just a close-up. Here we could see 7.5 trillion in 2008. It's now 15.4 trillion, the M2 money supply. But the silver stocks have only increased 15 billion. Back in 2008, they were about 30 billion. Now they're 45 billion. So it's only increased 15 billion compared to 8 trillion in the M2 money supply. And this breaks down the M1 and M2. The M1 money supply is currency. That's currency in circulation. That's the Federal Reserve notes and coins. We also include the demand deposits, which are checking accounts, and also other checkable deposits. That total is about 3.9 trillion, 3,951 billion, which is 3.9 trillion. Now, the M2 money supply, which includes savings deposits, small time deposits, and retail money funds. And this is money market accounts, CDs, certificates of deposit. It's 11.4, 11.5 trillion. So when you add both of these money supply together, it's 15.4 trillion. Now, this is just the US currency in circulation. A lot of it's overseas. But before the financial crisis, there was 817 billion in currency in circulation. Now there's 1.8 trillion. So it's almost increased $1 trillion in that 11 years. Now, why does all this matter? Now, this is a chart. It's very simple to understand. It's by Louis Arnault, based on the work of the Hills Group. The blue line shows us the oil production. Now, the global economy would not be able to function without energy. Energy is the number one dynamic that runs the global economy, not finance. So you have to focus on the energy. Now, what's interesting, as oil production has increased, the green line shows us the net energy used by the petroleum production system to produce the end products. That has continued to increase. So what that's increasing, what's happened, this orange line, tan line, that shows us the net energy from oil delivered to the globalized industrial world, the global economy. It is continuing to decline. So to make up for this, this here is the debt to GDP. And when Louis Arnault did this chart, at the time, it was 240%. That's global debt to GDP. If you look at the IIF, the Institute of International Finance, the most current update, the debt to GDP globally is now 322%. At some point in time, this whole system is going to crash. And what that means is that 15.4 trillion in this M2 money supply, that's either currency in circulation, it's in checking accounts and saving accounts, money market accounts, CDs, it's going to lose its value, because it's really, there's no intrinsic value to digits in an account or fiat money. There's no intrinsic value. Now here, we only have 45 billion in global silver stocks. So what does that mean? Each silver coin is a bank of energy equivalent value. Now, why is that the case, and why is silver money? It takes a certain amount of energy, capital, energy, as well as human labor to produce an ounce of silver. It's done that over the last 3,000 years. And so, because it takes a certain amount of energy, when you look at all the energy in all forms and in all stages, a silver coin represents a bank of energy equivalent value. And how much is that? Well, right now, with a silver coin worth about $18 at a gas price of $2.75 a gallon, it would buy 6.5 gallons of gas. Now, 1 gallon of gas equals the equivalent, the energy value of 500 hours of human labor. So 6.5 gallons of gas equals 3,250 hours of human labor, or one person working 8 hours a day for 406 days, more than a year. So that silver coin, because it took so much energy in all forms and stages to produce it, it has an equivalent value of 6.5 gallons of gas, or 3,250 hours of human labor. It's acting as a bank. Now, gold has a much higher energy equivalent value because it takes about 80 times the amount of energy, all energy, to produce an ounce of gold than silver. So if we look at the total 45 billion of global silver stock value in the world, investment silver, and purchased gasoline, based on 275, we would be able to purchase 16.4 billion gallons of gasoline. That's the energy equivalent value of all the investment silver. Now, the M2 tickets, the M2 money supply, its intrinsic value is zero. Because if you take a dollar bill, it costs 13 cents to make it. A $20 bill, even a $100 bill is like 15 cents. The thing is, there's no intrinsic value in fiat money or the digits of money that are in checking accounts, savings accounts. Those are claims for future right here. A M2 money supply has no intrinsic value other than being a ticket on future claims of energy. Silver is a bank of energy equivalent. So each dollar bill is a future claim for energy equivalent value. Thus, dollars equal energy debts. Gold and silver are energy banks of energy equivalent. That's the big difference. And I'm not even talking about stocks, bonds, and real estate. I'm just talking about the money supply compared to gold and silver. So when we put all this together, global silver stocks and energy and human labor equivalent value, the 16.4 billion gallons of gasoline that all the investment silver in the world would buy would equal 8.2 trillion hours of human labor, because there's 500 hours of human labor in each gallon of gasoline. So this 8.2 trillion in human labor hours would equal 2.8 billion people working 8 hours a day, 365 days a year. This is the hidden value I'm talking about. There is no intrinsic value in fiat money or the M2 money supply that's a digit in an account. There is hidden value in all the silver and gold in the world. And I don't believe a lot of precious metal investors or regular investors understand that. So again, just showing you one more time, this 15.4 trillion, that's doubled in the last 10, 11 years as the quality of oil is declining. These are tickets, and these tickets are increasing at an exponential rate, and they're not really backed by anything. So this little 45 billion in global silver stock value, if you think palladium is taking off, wait till investors understand this dynamic. The price and value of silver is going to really move up in the future. Again, I just want to say this one more time. This is the most important aspect. Energy drives our economy. Without energy, there's no economy. So you have to understand what's happening with energy. As the net energy continues to fall, it's called the falling energy return on investment. It's causing a lot more stress in the markets. The debt to GDP in the world is increasing. So all the paper money in the world is going to come under severe stress and be very problematic. And that doesn't even include stocks, bonds, and real estate. That makes the precious metals even a much more positive. We're just focusing now on the money supply. All right, in conclusion, again, it's important to remember each silver coin is a bank of energy equivalent value. Fiat money is a debt. It is a claim on future energy. So I wanted to thank you for watching this last video update. I believe most precious metal investors and even analysts and the market, the financial analysts, have no idea about the energy. They all tend to focus on the symptoms, the debt, the derivatives. Those are all big problems, but they're all stemming from this falling thermodynamics of oil depletion and the falling EROI of oil and gas. So in the future, I believe we're going to see what's happening with palladium. It's going to happen to gold and silver in investment demand on a much larger basis, especially with silver. Well, thank you very much for watching this last video update. If you have not yet subscribed to the SRS Rocker Report YouTube channel, please consider doing so. Thank you.